Assalamu alaikum, ladies and gentlemen. This is Khurram Zahir Chishti. I am a certified FRM, Financial Risk Manager. I'm a FMVA, Financial Modeling Valuation Analyst. I am a CBCA, Certified Banking and Commercial Analyst. I am a SCR, Sustainability and Climate Risk from GARP, the same institution which give FRM. I'm a AFM, Advanced Financial Modeler. Besides being a BBA, MBA from a leading business school in Karachi, Pakistan, IBA. And besides that, I've cleared 2 levels of CFA. So this lecture is the fourth lecture in the Basel series of lectures and the first lecture on Basel III. The first lecture which I gave in this series was on Basel 1. The second and third were on Basel 2, and now this is Basel 3. So let's go and try to demystify it, because as of now it's not yet fully implemented, fully understood, and hence the need to demystify it. To give you a background, though we have already covered, we'll just take one slide to see what this Basel issue is. So first of all, the Basel Accords are international regulatory standards issued by Basel Committee on Banking and Supervision, which is a body formed by central banks and regulators of the G10 nations. So Basel 1 came into effect in 1988, and primarily it had the key component was a minimum capital adequacy ratio of 8%. Like whatever you lend, whatever assets are of a bank, 8% of that you have to keep as capital. And why was it issued? Because inconsistent global levels, everybody had their own inconsistent policies. Every country had its own capital adequacy and capital requirements regulations, and this led to a lot of leverage and lot of arbitrage which people could use. Second came Basel II in 2004, and key focus is risk sensitive capital and three pillars. So what is it? I'll tell you. Whereas Basel 1 did not differentiate between a small shopkeeper and a blue chip company, Basel 3 gave these a particular risk rating based on their risk profile. And why was it? Because need for a risk based approach. We need to differentiate between the very goods and the not so good and the risky assets. However, come 2010 and 2011, post the global financial crisis of 2007-2008 in USA, which we call the subprime crisis, came Basel III, and its key focus is the capital quality, liquidity, leverage, systematic risk. We will delve into each of these concepts in the subsequent slides. And what triggered it was the global financial crisis. So question comes, why was Basel 3 needed when already Basel 2 was there with the three pillars of supervisory review, market discipline, and minimum capital requirements. So why was Basel 3 needed? First of all, Basel 2's weaknesses were exposed by the 2008 global financial crisis, which showed that capital was insufficient and of poor quality. For example, Basel II just required the banks to keep a particular 8% of their tier 1 capital. The components of the tier 1 capital, be they returned, the high valued components are the retained earnings, the share capital, the capital premium, the share premiums that they get. And also, they among the components of the tier 1 capital, also the subordinated debt, hybrid instruments, preferential shares, which may not be all that liquid. So the quality of capital came into questions. Leverage was excessive. Leverage for a bank simply means the deposits versus the loans it lends. Now, as we will see in the subsequent slides, leverage ratio has been kept at 3% of the bank's balance sheet, which in times of crisis, in the subprime crisis, there were certain banks, even the Foreign banks had 30 to 40% leverage ratio. Liquidity risk is ignored. Now, primarily, it means we all know what liquidity is, but when it comes to liquidity risk for banks, it means that bank, when they are doing interbank lending, they always have this satisfaction, they always have this comfort that they will go back to the central bank or to their other peers and do their one night or intraday lending. However, that was also brought to question. Pro cyclicality amplified downturns. Now, what does this mean? It means that during good times, bank lend a lot. Boom times are there. Already the market is flourishing, and the banks go on a they relax their credit standards. As a result, the boom becomes more amplified. On the other hand, when bust comes, we are in a low end of the cycle. So banks pull their strings, they curtail credit. As a result, during those times when the customers actually need credit, or when they require the required working capital loans, the banks pull their strings, cut short their limits, and hence they further worsen the dip. So pro-cyclicality amplified downturns, systematic contagion among large institutions. As you will see subsequent slides, we had this case of Lehman Brothers. Bear Stearns had to be bailed out. Lehman Brothers collapsed. So because the institution have done inter-institutional lending, and as a result, one getting into trouble means the others also will be impacted. So hence Basel III introduced a stronger multi-dimensional framework for solvency and liquidity resilience, which we will see. The crisis in action, the key events. So 2007 subprime mortgage defaults rise. We all know. I have lived through those times as well. So March 2008, Bear Stearns rescued by JP Morgan's. September 2008, Lehman Brothers collapses. It was a global panic because that bank had lending and borrowing with practically directly or indirectly with all the major institutions in the world. October 2008, AIG, the insurance company, American Insurance, Merrill Lynch, Wachovia, RBS needed bailout, credit market squeeze, global trade and lending stop because everybody comprehensive who will default, when will they default. So let's all stop. Everything came to a standstill. Central bank injected over 15 trillion. Yeah, that's correct. In liquidity globally. Yet nothing could be avoided. So what are the learnings, key learnings from these, and obviously which also shows the fault of Basel II. Number one, capital adequacy is not solvency. Though Basel II may have required banks to keep 8%, but that doesn't mean that things were solvent because it was hybrid capital. You had mix of hybrid instruments, debentures, loans, instruments, preference shares could not absorb the losses. Risk weights underestimated true credit and market risk. As per Basel II, you assign ratings to all shades of risk. You assign higher rating 1, 2, 3 as per Moody's to lower credit risk and rating of 5, 6, 7, and if they are defaulted then 7, 8, 9 also to those. But again, we all know the mortgage-backed securities were just garbed under these ratings and sold. Liquidity risk unrecognized, no 30-day survival horizon. That means that in the banks who depend on each other for just for fulfilling the gap in their balance sheets, they when the banks stopped lending to each other, so it created a liquidity crisis. Leverage unchecked, as I told you before, okay, it is how much deposits and how much sources of income and sources of continued sources of deposit which you have versus how much you lend and in which buckets you lend. So all these leverage, the 30 to 40%, even the foreign banks had lent. Systematic risk ignored. Institutions depend on each other because they directly, indirectly are are related. Given the fact that it's all a global village that we all live in. So let's delve further. So what are the lessons that we learn from the financial crisis? First of all, is the excessive leverage. Basel II had no leverage backstop and allowed higher growth or a higher growth on low risk weights. Like you can see, banks like Citi, Merrill Lynch had leverage ratio of 30 to 40%, and small losses wiped out their entire equity. Poor quality capital. Tier 1, as I told you before, included hybrid and subordinated debt that did not absorb loss. Basel II focused on quantity, not quality. It had no specific provisions about the quality, which now Basel III has, which we'll see in the subsequent slide. Liquidity freeze, interbank market froze, banks could not roll short-term funding. So Basel II ignored liquidity risk. Banking finance was taken for granted. Over reliance on models and ratings, which we all saw. The mortgage-backed securities were just assigned a rating as per the Moody's, and they were sold, and everybody blindly bought it, given the fact it's A plus rated, so it should be good. Banks underestimated risk of mortgage-backed securities, and internal models and credit rating were over trusted. Pro-cyclicality, which I told you before. Okay, during good times, banks lend a lot, they amplify the boom, and during bad times, they curtail the limits, they further worsen the debt. And systematic contingent, all the banks, all the institutions depend on each other, given the fact that one borrows from the other, he borrows from other, he borrows from other. It's a whole chain. And if one chain gets lost, the entire chain breaks, entire network breaks. So Basel III, what difference does it make and what are the key components? First of all, the total capital ratio, which means your assets versus the capital which you keep, is 8%, same as before. No change. However, there are certain changes inside that ratio, which we will discuss. Total capital is both tier 1 and tier 2. So the tier 1 capital has been increased from 4% to 6%. Now, what is this tier 1 capital? Tier 1 capital primarily has two components. One is the common equity tier 1, which is the highest form of a bank capital, and that is fully available to absorb the losses while the bank is a going concern. And what does it include? It includes the ordinary shares, which is the common stock, share premium, which is the paid in surplus, retained earnings, other comprehensive income, and the regulatory adjustments, which are deductions for goodwill, deferred taxes, and investments in other financial institutions. So the highest quality capital was its weightage from 4% was increased to 6%. Tier 1 also includes, and let me tell you, the this common equity tier 1 had no, for in Basel, this is the common equity tier had no, was made 4.5% in Basel 3. It had no specific mention in Basel 2. Total tier 1 capital also includes CET1, which is the common equity tier 1, as well as the additional tier 1, AT1, additional tier 1, AT1 instruments, which include perpetual bonds. There's no maturity for it. Preference shares or hybrid instruments that are subordinated to depositors and senior creditors. Instruments that can absorb losses via equity conversion to equity or write down when the CET1 falls below a certain trigger level. So it not only had tier 1 capital improve from 4 to 6%, but inside it, the high quality capital should be at least 4.5%. Capital conservation buffer, which, as the name suggests, it is an additional layer of 2.5% of RWA that banks must hold on top of the minimum capital ratios in CET1 form, which means that now banks, in addition to their CET1, which is 4.5% as per Basel III, they need to have a capital conservation of 2.5%, which of the highest quality of capital, which is share premium, share prices, retained earnings, and that way. So banks should build up extra capital in good times, in normal times, so that they can draw upon it during stress without breaching the minimum thresholds. If the capital dips into this buffer, for example, if 2.5%, if they feel can no, they are struggling to make this percentage, then all the dividend payout, bonuses, and share buybacks are restricted until capital is rebuilt. This counter capital conservation buffer discourages excessive distribution during good times and encourages prudence. Next is the counter cyclical buffer. Again, it had no place in Basel II. In Basel III, it is supposed to be between 0 to 2.5%, which is again from the CET1 capital, which is the highest form of capital. However, the counter cyclical buffer is, there's a range given to it. It's as per the regulator, which can decide. And the counter cyclical capital buffer is a variable buffer 0 to 2.5% built from CET1 capital, which is the common equity tier 1 capital, applied at regulator's discretion. This Basel has given a range. Now, as per the central bank of the various countries, they can suggest where to put the mark depending on the market situation. It increases during credit booms and decreases during recessions. And the reason is Basel II was highly pro-cyclical. Credit expanded in booms and contracted in downturns. On the other hand, the counter-cyclical capital buffer, it smoothens the cycle and increase during credit booms to curb risk taking and release during recessions to free up lending. So these subsequent slides of now the cap as in these subsequent slides they delve further into it, like for example total capital ratio slash tier 1 ratio. Total capital, when we which we know is 8% both in Basel 2 and Basel 3. It consists of tier 1 and tier 2. Tier 1 is a core capital that absorbs the losses. Tier 2 is a supplementary capital that absorbs losses the banks falls. So what are their purposes? All are given over here with examples. This is followed by the core component, which I had discussed with you about the common tier, the C common equity tier 1, and what does it's the highest form of the bank capital. It consists of ordinary shares, common stock, share premium, retained earnings. On the other hand, the tier 1 capital also has the additional tier 1, which is the AT1, which includes perpetual bonds, preference shares, hybrid bonds, instruments that can absorb losses by converting into equity. So the tier CET1 is a higher form, more liquid form of capital, which absorbs the capital losses first. Capital conservation buffer, as we discussed, was a 2.5% of RWA, and the rationale of it so that during bad times the they can bank can fall back on it. Similarly, counter cyclical buffer to smoothen the effect of the boom and bust cycle, which we spoke about. And now comes the leverage ratio. Leverage ratio, as we discussed, was basically the tier 1 capital over the total exposure, assets plus off balance sheet, of which primarily means of the bank lending. How much is the tier 1 capital? Earlier, as per Basel II, there was no bar on it. Even some of the very known banks had 30 to 40% leverage. Basel III specifically states 3%. And the reason is that Basel II relied on a risk-weighted assets, allowing balance sheet expansion in low-risk assets. However, when those assets turn risky, for example, the mortgage-backed securities, banks were over-leveraged, and the leverage ratio provides a simple backstop for the risk-based capital measures. Again, another for the liquidity, Basel III has introduced two ratios. One is the liquidity coverage ratio and the net stable funding ratio. Now, what are these? Liquidity coverage ratio is a liquidity ratio for the short term. Net funding ratio NFCR is for the long term. As you stated here, a liquidity coverage ratio is a short-term resilience, 30 days. Net funding ratio is a long-term financial stability, 1 year. Formula is for the liquidity LCR is HQLA, which is the high quality liquid assets, and these assets include the cash, the central bank reserves, and the top rated government securities over the net cash outflows. So banks should have the net cash outflow which they expect for the next 30 days to they should know about it, they should have a liquid bucket and how much they have the cash against it. Net stable funding ratio, which is for the long term, which and how to calculate it is available stable funding divided by the required stable funding. Now, what is available stable funding? Available stable funding, of course, for a bank, the stable funding comes from the customer deposits It could be long-term loans, long-term equity, whereas the required stable funding are the assets and its commitments, and the long-term loans it has given. Now let's delve into each further. Liquidity ratio. Again, liquidity risk was a major oversight under Basel II. Many banks failed not because of insolvency but illiquidity. Insolvency means it's not that they did not have the money, did not have their liabilities were more than their assets. It's not, they were not insolvent per se, but the very fact is that their sources of liquidity dried up, or the other banks could not lend to them. So Basel III introduced two global standards to address this. One is, as we discussed, the liquidity coverage ratio objective. Bank can survive a severe 30-day stress. For the formula we have spoke about, high quality liquid assets over net for 30 days, high liquidity assets into central bank reserves, and in that also we have some gradations. Like for example, you can have a level 1, level 2A, level 2A that is all depend on the liquidity and the source from it's coming from. From the cash and the central bank, it's the most purest form, no haircut applied. From the sovereign bonds, you have a 15% haircut, and you have higher haircut in terms of the corporate bonds. Now, for the net stable funding ratio for the long term, as we discussed, it is for long term lending. And how to calculate is available stable source of funding divided by required source of funding. Available source of includes customer deposit, long term loans. Required funding means the long term assets requiring fund, long term loan commitments. So both these address the liquidity part. Now, overall, if you see the of Basel III, it has the leverage ratio, non-risk 3%, counterparty credit risk buffer, systematic risk. So primarily, one of the basic difference between Basel II and Basel III was that Basel II gave total capital ratio, it gave disclosure requirements. So it was more of a micromanagement on the bank specific factors it gave. On the other hand, Basel III giving a counter cyclical buffer, a capital conservation buffer, is more on the macro view or to prevent the system from facing issues. Now, timelines, as I said, even now across the globe, you have some financial institutions still struggling with Basel II. So Basel III is yet to be adopted. So if we see some timelines are given, 2010, the framework got approved. Then up to 19, the phased capital rules came out. Then LCR phased in 2019, 2018, NFCR implemented. NFCR banks are doing it for the liquidity. 2023-2028 Basel III finalization. So it's still under progress in UAE. CBUA fully aligned with the Basel III 2008 finalization ongoing. So as such, it's an ongoing process, and let's see how this goes. So kindly subscribe my channel, and we will bring another video for the Basel IV, which is now there. Of course, it has some digital and the cryptocurrency uh, components as well. So thank you, ladies and gentlemen, and appreciate your feedback on the improvement of my channel. Thank you.